Welcome. Today we are going over the basics of bookkeeping. Now, bookkeeping is the recording and organizing of transactions within a business. Now, this could be any business, right? This could be anything from your small town restaurant to something as complex as a Fortune 500 company. So I'm excited to start. Let's get right into it. So as I said, bookkeeping is the recording and organizing of transactions that happen within a business. So we want to define transactions as broadly the activities that exchange goods, services, money, or assets between two or more parties. In this case, parties being buyers or sellers that are involved within the transactions. So you might be asking, why do we track all the transactions that go on within a business, right? Well, the first reason that comes to mind is just to assess the general financial health of the company. So this is to answer questions like, is the company at a profit or a loss? Or to questions like, do we have enough assets to fulfill our obligations in terms of liabilities that we've accumulated? To maybe more in-depth questions that really require going into the semantics of the data. The second reason is making strategic and informed decisions. So from the bookkeeper to the analysts to the accountants, controllers, business owners, or anybody really within the business looking at the data, they need to determine what moves they need to make in the future for their respective departments or just for the business as a whole for the betterment of it. And this is where maybe something like financial strategy, forecasting, uh, budgeting, all of these things come into play. And it makes it really clear what the objectives are moving forward. So that's why it's also important. And the third reason is aligning with compliance and tax rules, right? We want to stay away from any issues regarding legality, prevent any errors or frauds, and as well as pay the proper amount of money to the IRS in terms of tax. So as I've said, from the local mom and pop shops to the big multinational corporations, bookkeeping and accounting is always needed. And you also need to have the data, which in this case is transactions, to know your past so that you can gain better clarity for the future. So now over the next couple of slides, we are getting into the fundamentals. So all transactions that are identified within a business can be categorized into 5 main accounts. So these are assets, expenses, liabilities, revenues, and equity. Now, an asset is any resource owned and or controlled by the business. So this could be anything from cash on hand to the inventories that we bought and now we are selling to customers to the accounts receivable account. So this is where we keep track of money that we are owed, but we aren't paid yet, right? So anything, for example, that a customer buys from us on credit, we are owed that money, but we just haven't been paid yet. So that is where the transaction would go, the accounts receivable account. So now we have vehicles, buildings, equipment, and more. The second account is the expense account. So the expense account is costs incurred from business operations. So this could be anything from the rent to the office supplies, phone bills, salaries, anything along those lines. The third account is the liabilities account, and that's any value that the business owes that we have not paid yet. So accounts payable is an account that comes to mind, which is the inverse of the accounts receivable account, right? So this is money that we owe other maybe businesses, suppliers, vendors, what have you, for any goods or services that we bought from them, but we just haven't paid yet. And we will pay at a later date. We have credit cards, loans, mortgages, and payroll. The fourth account is the revenue account. So this is income from goods and services sold from the business. So we have sales revenue, interest revenue, we have services revenue as well. And we have also revenues like royalties, right? Royalties is essentially any asset or intellectual property a business owner owns. If that is used, then the business owner profits from it. So say if it's a musician or songwriter, right? That is an example that comes to mind. They write a song. If the song is played on the radio, TV shows, movies, uh, any really form of medium, then the musician gets paid. So that's a good example to keep in mind when we are talking about royalties. Last but not least, we have equity, which is what the business is worth. And this is the difference between the assets and liabilities. And we will go more into depth on this in the balance sheets portion of the lesson. But for now, we have accounts like owner's equity, common stock, and retained earnings as examples. So for the 5 accounts that we just talked about, we need to learn to record the financial effects of the transactions. So the way we do that is an accounting entry called debit. Now, debit increases in assets or expense accounts and decreases the revenues, liabilities, and equity accounts. Whereas credit is the inverse, right? It increases the revenue, liabilities, and equity account and decreases the assets or expense accounts. So the reason we do this is because of a method called double entry bookkeeping, which is for every transaction needs to be recorded with an equal debit and credit in 2 or more accounts. So that is the main method of recording transactions. This is used widely by most businesses because it essentially just tracks money going in and out of every account within the business, ensuring that we have accurate records of transactions. So with double entry bookkeeping, tracking every transaction to make sure it's accurate going in and out of each account, we can now create the financial reports. So from this information, we have the revenue accounts and the expense accounts ready. We have all the info on that, and we can make the income statement. From the income statement information, assets and liabilities account information that we have, we make the balance sheet. And then double entry bookkeeping also ensures that the balance sheet is balanced, which is very crucial. And we will go over the reasons of why that needs to be in the balance sheets portion of the lesson. But it is also crucial for bank reconciliation as it prevents errors and discrepancies when we are comparing our company records to the bank records. So don't worry if everything I'm stating is confusing. We'll go more into detail on this in later lessons. But for the next lesson, we will be going over transaction examples that happen in all the 5 main accounts. And we will go more in depth after that on the financial reports. So thank you for watching and see you in the next lesson.